Welcome back. You're watching our series London Eye. I've been in conversation with Russell Napier. What should emerging market investors worry more about? The fact that interest rates might go up in the US and therefore it will turn out to be bad for EM equities? Or the fact that some of these recent numbers as they're showing up, we are headed towards softer economic conditions and that ultimately will hurt emerging markets more?
Yeah, I think you've got to look at the US current account deficit. That's the transmission mechanism through which it sends liquidity into the emerging markets. And the more America grows, the bigger that deficit should get. And that's what emerging market needs. So what's good for emerging markets is definitely growth in America, particularly a certain type of growth, which is heavy on consumption and heavy on the consumption of goods. And that's what you've got to focus on. And interest rates, I really don't care if rates go up. If that starts to pick up really quite markedly, I'm a buyer of emerging markets, even if interest rates go up. So I think emerging markets are wrong to get excited every time the American economy slows. And the fundamental problem we have in emerging markets is the US current account deficit is really small compared to where it's been historically. I mean, at its peak, 2007, it was almost 6% of GDP. We're now looking at somewhere between 2 and 3% of GDP. And this is an economy that's growing. It's an economy that's growing without blowing out its current account deficit. And I think that's the future. I think what we're witnessing here in the way America grows is it's growing with reasonable consumption, but the consumption's shifting to services. The baby boom generation has got lots of stuff and shifting to services. And therefore it grows well, but it doesn't grow with a bigger and bigger current account deficit. And that's the problem for emerging markets. So there's a message in there. This is what you should look at. Don't look at interest rates. Look at US growth in the current account, but also a forecast. That is, even if America does pick up, and I'm wrong, and it is picking up, I think it's found a new way of growing without a significant deterioration in its current account, and that causes structural issues for emerging markets, and that's the big story for emerging markets. If this is the way America is going to grow going forward, and Europe, big current account surplus, and Japan, big current account surplus, Asia, emerging markets need to find a new way to grow. And that's a structural challenge which they haven't really tackled head on yet, and they're going to have to tackle that head on.
Emerging market equities have not made a lot of money for global investors over the last few years. There is a school of thought which is hopeful that this might begin to change. But you're suggesting that the time is not here yet. You would be better off staying underweight in emerging markets?
Yeah, I still believe that. I mean, what I've done is I've looked at, I wrote a book called Wall Street, looking at Wall Street's Four Great Bottoms, Anatomy of the Bear. I've done that for Asia. I've looked at certainly the 2 times in the last 25 years when Asian equities have got cheap, and I've looked at the conditions that made them cheap, and then I've looked at the conditions today. And fundamentally, something happened in 1998 and 2003 that hasn't happened today. And I think we need it to happen today before we can get bullish on equities. Now, it's not valuations of equities because they look pretty reasonable, but it's the condition of the external accounts. I, rightly or wrongly, have always believed that the important place to start with emerging markets is external accounts and work backwards, and that's its current account and its capital account. And what we notice in 98 and 2003 is massive improvements in those external accounts. Now, we have seen improvements. The slowdown in EM growth has brought improvements in the external accounts, but it's nowhere near the scale that you associated with the great bear market bottoms of 98 and 2003 for emerging market equities. You know, the data for the US current account is really worrying in terms of their imports of goods in particular. It's contracting, and some of that is price, but I think there's more and more evidence by the day that actually some of that is actually volume. So I can't get excited about the external accounts for emerging markets, and therefore, even though the equities are cheap for a long-term investor, I can't get excited about those equities either.
So what's your prognosis that sometime this year people will realize the truth of what you're saying, that is how the cookie will crumble and we get into another bear market kind of situation?
Yeah, I think the Japanese have already realized it. I mean, I think what's happening in Japan in the last couple of months is absolutely crucial. The fact that Prime Minister Abe would travel around the world telling people we're ready for a Lehman-style crisis is remarkable. I don't know if he believes it or not. I've no idea whether he believes it, but he clearly was doing it to try and instigate a global response, to do something that he wants to do. Try to persuade everybody else that what he wants to do is the right thing to do. So the focus, I think, will be in Japan. Now, maybe I'm wrong. Maybe Japan doesn't have a really dramatic answer to this, but I'd be really very surprised if they didn't. So if I'm looking from here to the end of the year, you know, we've talked about some things that could go wrong. Most, when I go to visit my clients, we mainly talk about governments and central bankers and what surprises they're going to have, and I would say look to Japan, because there could be a very big surprise coming for Japan. That famous helicopter speech that Bernanke makes, he runs through all the things a central bank can do to defeat deflation. Japan's done all of them, except one. And that last one is this fusion of fiscal and monetary policy. I think it really changes the world when that happens. We see just how far governments are prepared to go. And I think that's going to be the key factor driving equity markets in the second half of this year.
What will convince you that deflation has set in, that it's entrenched?
That's a great question, because deflation comes in, I think, two different formats. There's one just where there's too much supply of goods relative to too much demand for goods. And that one actually doesn't frighten me as much as it frightens most people, because ultimately you should begin to control some of the capacity. The one that is really frightening is where we do have another Lehman Brothers event, another crunch to the credit system. And if you look back to the inflation data for 2007, 2008, it's actually rising. Inflation's rising. The economy peaks in America in December 2007, inflation goes up, and then it just drops like a stone. And it's beginning to fall before Lehman's, and when Lehman's come, it drops like a stone. So a dislocation in the financial system now was the thing that would really convince me that we're heading for deflation. You know, judging the powers of supply and demand is difficult. They tend to act fairly slowly. The inflation data tends to come down very slowly. But if you get a dislocation to the global credit system, then it can just come down rapidly overnight. We've seen that once before. We've seen it more than once before, actually. I think you saw it in '98, you saw it in 1982, pretty spectacularly in 1982 as well. So anything that happens to the global credit system, and I think that's it, we're definitely heading into certainly a developed world deflation. Whether it gets to deflation in emerging markets is a different issue. So that's the key thing to look out for. And there's so many places where that dislocation could come from, where people would not be able to repay their debt. We had huge worries about commodity stocks 4 months ago. I still have lots of worries about commodity countries. I have lots of worries about the Italian banking system. So that credit shock is the thing where you just say, well, the central banking isn't going to be able to cope with that in isolation. To stress, there is an answer, but it's central bankers working in conjunction with governments. And most governments aren't ready and prepared to do that yet.
Is there any part of the financial market, forget the equity market for now, which is telling you that they're beginning to pick up some of the signs of what you're saying, either in the way the yield curves are positioned, any of the bond prices, currency movements, anywhere? Do you sense that people are cognizant of the risks that you're talking about?
I think so. There's a real conflict in the market. So, I mean, as you can tell, I'm pretty pessimistic about the world, and therefore my own personal portfolio is pretty pessimistic. And I do hold American 30-year bonds. Well, as of this morning, they'll be up 9% in dollar terms this year. Is that a sign that the world is getting better, that this price of the dollar is up? The fact that the gold can go up on days when the dollar's up, the fact that people seem to be buying gold as a safe haven, is that a sign that the world is relaxed? And I keep coming back to that collapse in European bank equity prices. You know, Mr. Soros has this wonderful phrase, he says reflexivity, which is when the price of a security affects the fundamentals. Well, I think the most reflexive security price in the world will be bank equity prices, and it's just hard to believe. I mean, if the world's really getting a better place, why are we watching many of these share prices halve in a year? So there's lots of things going on over here that tell you things are getting worse, and then you look at the sort of broad equity indices and they're doing reasonably well or doing all right. So there's a massive dichotomy in the markets at the minute. It's telling you two different things at the same time. Not a great surprise to me, because the more the governments get involved in markets, the less markets are coherent, you know, the less they're able to tell you something about supply and demand, because the government's such a big part in all of those things. So there's this sclerotic market action going on at the minute, and obviously one's going to have to be right, one's going to have to be wrong.
My last question to you, I know it's absolutely impossible to time these things, but if you had to guess, do you think this will be a slow, drawn-out kind of a process, or do you think the shoe drops this year sometime? Yeah,
so that's another great question, because I've been, focusing on this for several years now, and it's been happening very, very slowly. I mean, if global inflation's been coming down, it's not been going up. There's been some distress in the credit sphere. All these things have happened, but happened very slowly. It is unlikely that they continue to happen slowly. I mean, I would forecast that it will happen quickly when it does happen. Will it be this year? Perhaps, but it will happen quickly. A credit distress event is something that, rings around the world quite quickly. A major decline in the yen, if that is the repercussions of a move to this fusion of fiscal and monetary policy, has implications very, very, very rapidly. So it's hard for me to look at the world. I mean, the structure of the global system seems to be held together with a piece of string, frankly. A very piece of string, it's hanging by this piece of string. It just seems to keep getting narrower and narrower and more fragile. So it is very difficult for me to believe that this can get to its conclusion in a smooth fashion, that that piece of string has to break, and what I mean is the credit system. Something that goes wrong in the global credit system seems to be more likely by the day.
You scared me, Russell. Thank you very much. It's a pleasure listening to you.